Time now for Trading Nation. Today, let's trade the banks and financials because as a group, those stocks are hitting some of their highest levels, not of the year, but since the financial crisis. Many names up 20-30% in the past 90 days. Matt Maley is with Miller Tabak. Dennis Davitt is with Harvest Volatility Management. Matt, how much of this is the change in the yield on bonds, which maybe makes banks' balance sheets more attractive, or, in your trading view, just simply a sector rotation from tech to banks?
Well, like many things in the market, it's a combination of that and also, of course, the fewer regulations that people are looking for, anticipating from the Trump administration. The one thing, though, as you mentioned, the group is up incredibly in the last 3 months, and it's getting very extended. I'll be honest with you, I'm not a big believer of chasing the group right here, and maybe the biggest reason for that is because the bond market is getting incredibly oversold and incredibly overhated. The futures traders in the Treasury market are only 6% bulls. That's very, very low. So that's getting very ripe for a bounce in price, which will bring yields down and will flatten the yield curve. And that, well, I think, will give the people excuse to take this overbought group on a technical basis and pull back a little bit. Again, that sentiment's something that usually leads to a multi-week bounce, at least a week or two, maybe not a multi-month one, but it's more than just a day or two of a bounce. So I think you're going to have a better opportunity to buy them on weakness in the coming week or two.
Okay, Matt Maley making a little bit of a cautious tone there. I mean, yeah, Dennis, I mean, listen, I don't know if a lot of people know this, but Morgan Stanley shares have almost doubled since their February low. Morgan Stanley has almost doubled since its February low. What is your take on the banks and financials?
I mean, people have been talking about it all day, about the raising yield that will help out the banks. And there's a legitimate case for that. And there's a case for heightened economic activity. I don't know where these thoughts were 2 or 3 days ago. Now they're suddenly on everybody's front burner. But the one that scares me is everybody thinks that there's going to be less regulation on the banks going forward. I don't see that. Even if they were to repeal Dodd-Frank tomorrow, for the banks to get back in motion, they spent the last 8 years growing out their compliance departments. They're not growing out their proprietary trading departments. So if you're buying, the best way to play this is with options. I mean, I'm obviously biased, but there's real smart money out there buying upside inexpensive calls in the banks. If they continue to defy gravity, it's a great option to own. And if you own these banks, if you were fortunate enough to call this all right, buy some puts against your positions. Go out and spend 30 cents on some year-end 21 puts in the XLF.
Okay.
Just to get yourself hedged. It's really a long stretch right now in the financials.
Yes, okay, a dual note of caution there on some of the banks and financials, which have had incredible runs. Dennis, Matt, thank you both very much. For more Trading Nation, go to our website, tradingnation.cnbc.com.
Different sectors of the market tend to do well during different periods of the economic cycle. When the economy is expanding, industrial and technology stocks have historically outperformed the broader market. When the economy is contracting, more defensive sectors such as utilities and consumer staples tend to outperform. So when choosing to invest in a particular sector, be sure to consider where we are in the economic cycle.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.